Your P&L says you had a great year. So where the hell is the cash? And why is there a balance on your line of credit? Get ready to fix this. Most of the law firm owners that I talk with are profitable on paper, but many are broke in the bank account, and many of them can't tell me where the money actually went. Welcome back, my friend, to the Lawyer Millionaire Podcast. I'm glad that you're here with me today. So here's what I want you to take away from today's episode. And it's a simple idea, and it seems elementary, but there's a lot to it. And I'm hoping that today's episode can convince you and motivate you around this idea. Profit and cash are not the same thing. And the gap between them is where most firms get into trouble. Today, we're going to be talking about working capital and the forces of cash flow. There's a concept that I want to introduce to you. It comes from the book that we're reading right now inside the Lawyer Millionaire community, which is Simple Numbers by Greg Crabtree. And by the way, if you're not a member yet of the Lawyer Millionaire community, you are seriously missing out. So what are you waiting for? Go to community.lawyermillionaire.com and join today. It's free. Okay, so the concept I want to tell you about is core capital. You need core capital. Every business does. Now, what is core capital? What the heck am I talking about? And by the way, this applies to you whether you have a 6-figure firm or a 9-figure firm, because I've seen firms of all shapes and all sizes struggle with this concept. What is core capital? Core capital is the minimum amount of cash that a business needs to survive. The bigger your business, the more money it needs. Think of it like the oil that lubricates an engine. The bigger the engine, the more oil you need. It doesn't do anything per se. It's not fuel. You're not burning it to make the vehicle go, but you need the oil in the engine to keep things running. It's just there in your business, lubricating the operations. That's what core capital is. And here's the minimum core capital requirement. How much core capital do you really need? Well, when you've met these requirements, you've met your core capital requirement. And generally, they are this: 2 months of operating expenses sitting in cash, nothing drawn on your line of credit, nothing carried on credit cards, so those are paid down to zero. And third, your taxes are either paid or set aside. That is the bar. That's when you know you have sufficient cash. Your oil meter, the dipstick, is where it's supposed to be. That's what a healthy firm looks like underneath. And now that we have a name for it, you have something to build towards. Okay, now why should you care about this and why does it matter so much? Well, let me tell you, and this is really, really important. You should care about this deeply because every single decision that you make in your firm is shaped by how much cash you have. Think about it. When you don't have core capital, you make scared decisions. You delay the hire that you know you need. You take the case that you shouldn't take. You discount your fee to get the retainer in the door. Or you don't take the case that you want to take that might put you in the multi-million-dollar advocates forum because you're worried about case costs. Working capital is what gives you the freedom to say yes to the right opportunities and no to the wrong ones. Every business needs working capital. Working capital, core capital, same concept. Your business is no different. Now, let me tell you why this matters so much in terms of numbers. I've worked with lots of firms carrying tens of thousands of dollars a year in interest costs on lines of credit and credit card balances. I've seen firms with carrying costs in the hundreds of thousands of dollars. Think about that for a second. Hundreds of thousands of dollars every year going out the door to a bank. Money that could have been an entire attorney's salary. That could have been a marketing budget. That could have been your retirement contribution. Oh, okay, now we're making it real. Instead, it's interest that went to the bank. And the only difference is, and it's like, well, I don't want to leave money in my business because I need that money in my personal accounts. Well, once you've built it up, then you don't have to do much. It's going to replenish itself, but you've got to build it up first. And the worst part is that interest. And let me tell you why interest is so bad. Because it's insidious and it's secretive. It doesn't get pulled from your bank account. It just gets charged to the credit card or the line of credit. And you keep paying the minimum while it builds. So Have I convinced you yet? Well, let's think through this. If you're profitable, but your bank account is empty, the money went somewhere. Okay, so let's start there. Everyone's like, okay, my business is profitable, and that's the title of our episode today, why you're profitable and there's no money in the bank. So let's talk about it. Well, the money went somewhere. It always does. Usually it's one of a few places. You bought something, some equipment, some software, an office build out. You paid down debt, which feels good, but it moves cash out of your bank. Maybe you took an owner draw or a distribution. You don't have the cash in the business because you took it. Or you paid a tax bill. Maybe you funded a big case that hasn't settled yet. Whatever it is, the money didn't just disappear. It just got reallocated. It went somewhere. It's a closed system, often without you really tracking it. And then one day you look up and the operating account is thin and the line of credit is full and you can't explain how you got there. The line of credit, by the way, is meant to be a last resort, something that you tap for a true emergency or a known short-term gap. It's not meant to be a funding mechanism for your day-to-day operations. It shouldn't be how you meet payroll. When the line of credit becomes part of how you run the firm, you've crossed a line and you need to walk yourself back across it. And my friend, this is where Profit First really becomes useful. This is why we started this year with Profit First, and now we're moving into simple numbers because Profit First built the foundation. If you're already running the system, and if you're not, this is your nudge to start. You have a profit account already that's quietly accumulating money. You have a tax account that's holding back what you owe the IRS when the money comes in. These accounts are doing exactly what they're supposed to, protecting cash from you spending it or taking it. And when you have excess cash building up in your profit account, then you can start to use that excess cash to build up your core capital. And here are the 4 ways that you should use this money. First, you want to pay down debt. You have extra cash in your profit account at the end of the quarter. What do you do with it? Number 1, you're going to pay down debt. High interest debt first. Credit cards, anything double digits, then your line of credit, then any other debt that's costing you real money. We've got to get you out of debt. Number 2 is usually taxes, but you've already got taxes taken care of because you're already running Profit First. You've got your tax account. You're setting aside the tax money as you get paid. When you get paid $1,000, you're getting 20% of it and throwing it over into the tax account immediately and not touching it until it's time to pay your estimated taxes or to pay the final tax bill, right? Okay, so we don't need that. But instead, second is building your core capital. Number 1, pay off debt. Number 2, now building your core capital. Get yourself to that 2-month cushion. Take that excess money in the profit account, move it over into your core capital fund or your emergency reserves fund and build it up. And by the way, that account should be a high yield savings or a money market where it can earn 3 to 4%. Now imagine this, folks. You've built up your core capital. You have a couple $100,000 sitting in your core capital, earning you 3 to 4% a year. That could be on $200,000, $6 to $8,000 a year. Wow, look at that, passive income, okay? So that's the idea. Now, number 3, after you've done that, number 3, we can pay bonuses to your team if that's part of your structure. And number 4, we can take owner's distributions. But don't you dare take owner's distributions until you've paid down the debt and you've built your core capital. Okay? It's like starving the cow that you're trying to get to produce milk. Your cow needs to be fed. Okay. Now, the order matters. Debt and core capital, like I said, come before rewarding yourself because you need to keep your firm strong. When your firm is strong, when your business is running, when you have a well-oiled machine, pardon the pun, you have a business that's going to continue to reward you over the long run. Now, here's the question I get from a lot of law firm owners. Darren, this sounds great, but I'm in the credit cycle right now. I can barely cover payroll. How am I supposed to build core capital when I'm trying to pay off debt at the same time? Well, first of all, we've got to fix the profitability problem. You have a labor productivity problem. Either you have too many staff, or your staff are under-leveraged or underproductive, or you have a pricing problem. There's something going on in your business that's not producing the true amount of profit that we really need, okay? But number two, and here's the logistics of what we're going to do. You're going to siphon off 1%, just like you would your profit account. You're going to use your profit account to build that core capital. And you're going to start by taking 1% of every deposit that comes in and putting it into that account so that then it can go into your core capital account. Now, you might want to start this even while you're in the credit card cycle because you got to start building somewhere. Now, here's the beautiful thing about 1%. You're not going to miss it. You won't even notice it. But over a year, on a firm doing $1 million in revenue, that's $10,000 sitting in core capital that wasn't there. And I know that's not a lot, but it's a start, and you've got to start somewhere. The act of forcing yourself to run on 99% of revenue is also itself a discipline that will change how you make decisions. The key principle here, and this is critical, is that constraint creates clarity. When you have unlimited access to a line of credit, you're not really thinking about your spending. Your spending decisions become fuzzy. You're not making hard decisions based on real math. You struggle to say no to the salesperson. And if you really were honest with yourself about how much money you actually do have, it would be a lot easier to say no. You're not having to make those hard decisions. You're spending freely without thinking. When you make yourself operate on what's actually in your operating account, you start asking better questions. And when you start really making core capital a big deal for yourself, then you really start to ask these questions as well. Questions like, is this hire really necessary right now? Is this software actually paying for itself? Could we collect retainers faster? Constraint forces you to run a tighter, more profitable firm. The line of credit, ironically, is what's letting you run a sloppier one. And one more thing that I want to say. Don't go into debt to fund growth. I know that's not what the marketing salesperson is telling you. It'll just pay for itself. Just put it on a credit card. You could qualify for financing. It's also not what you may hear from many other business coaches. But you know what? And here's why I say it. I've watched too many firms borrow their way into trouble chasing a growth curve that didn't materialize. We talked about this before. Go back and listen to the Profit First episodes that we did earlier this year. It's this growth at all costs mentality that causes us to starve our own businesses and put ourselves on the verge of bankruptcy. Growth funded by a well-capitalized firm, that is a firm that has sufficient core capital, sufficient working capital, is durable. Growth that's funded by debt is dangerous, it's risky, and it is fragile. So, here's the one thing I want you to do this week, friend. If you haven't yet, open up a separate savings account. Just go online, it'll take you a few minutes. Set up an automatic transfer of 1% of every deposit that hits your income account into that separate savings account. If you can't do a percentage, just pick a fixed dollar amount that's going to approximate that 1% and start there. And don't touch it. Don't you dare. Don't even look at it until the end of the quarter. That account is the beginning of your core capital. And if you're not sure where to put it, you're going to be looking for a high yield business bank account. Now, unfortunately, there's not a lot of great high yield business bank accounts out there. So what we like to do here at the Lawyer Millionaire for our clients is set up an account, a brokerage account, a business brokerage account. Yes, your business can buy and invest in stocks. Did you know that? But we're not going to buy and invest in stocks. We're going to buy a money market mutual fund that can pay us 2, 3, or 4%. Okay. And then you're going to start to see that grow and accrue. That account will be the beginning of your core capital. And as you get comfortable with that 1%, you can then slowly bump it up 2%, then 3% until you get sufficiently well capitalized. That's how this gets built. Quietly, consistently, one money movement at a time. Now, I do love this topic so much, and I know it sounds simple, but it's so powerful because I've seen how it completely transforms firms. Before you hire, before you grow, before you do anything else, get out of the credit card cycle, get out of the line of credit cycle, and start operating on a sufficient reserve of working capital. It will transform your business. It may sound simple, but core capital is critical at every stage of law firm ownership. And for firms of all sizes, big and small, 7, 8, 9, 10 figures, okay? Think about a company like Apple. They have sufficient working capital. They need to, okay? In fact, it's even more important the bigger you get, because the bigger you get, if you don't have that working capital, the bigger the consequences. But as you grow, I know it can be so easy to lose sight of these foundational principles. Here at The Lawyer Millionaire, we help law firm owners like you expand their businesses, maximize profitability, and grow personal wealth through an integrated family office style team that combines business coaching, tax planning and filing, and personal wealth management all under one roof. And Core Capital is the perfect example of why that integration matters. Topics like building core capital aren't just a business decision. These are also tax decisions and personal financial decisions. They have implications across all three disciplines. And when these conversations are happening amongst three different people who don't talk to each other, things fall through the cracks. When they happen under one roof with one team that sees the whole picture, you actually get somewhere. And that is the work that we do. If you've been listening to this and quietly recognizing yourself, if you know you're profitable but you can't seem to keep cash in the bank, let's talk. Book a call with me. The longer you wait, the more interest you pay, and the longer you stay stuck in that cycle. Every month you delay is real dollars walking out the door. The link to book some time with me is waiting for you down in the show notes. And if you're not quite ready for a one-on-one, come join us inside the Lawyer Millionaire community. Come hang out with us. It's where law firm owners like you are working through exactly these same questions together. You'll find that link in the show notes as well. Well, that is it for today, friend. But remember one thing. If your law firm isn't building you wealth and freedom, what the hell are you doing? Can I get an amen up in here? Now, go make it happen, and I'll see you next time.